I make hundreds of thousands of dollars doing this little known options trading strategy that I'm going to explain to you in this video right here. This strategy is how I turned my portfolio from $270,000 2 years ago to over $778,000 right now. I'm going to explain step by step everything that you need to know, because this, in my opinion, is the #1 options trading strategy that nobody knows about. So here we go. So heading over to my options trading spreadsheet, I've made over $115,000 this year, and it's only July. I'm looking to hit over $200,000 this year with my options trading, and I'm trying to get my portfolio to over $1 million this year. So the strategy that I'm going to explain to you guys today is the wheel strategy. Now, you've probably watched other videos explaining the wheel strategy, but you've never seen the wheel strategy done by someone that turned their portfolio from 200K to 700K in less than a couple years. So this is what I do. So as most of you guys already know, when you buy or sell options, that is the right, but not the obligation, to buy or sell 100 shares at a certain price in a certain time frame. So if you buy one call contract, you are able to buy 100 shares in a certain time frame. Now, the two other things that you need to know about options is the strike price and the expiration date. So the strike price is the price that you'll either buy or sell the shares at, and the expiration date is the time period that the contract is valid for. So anything beyond the expiration date, the contract is no longer valid for. And then with options, there's always call options and put options, and then there's a bunch of other complicated spin-offs from that. But we're gonna focus on the easiest way to make money, the safest way to make money, and the way that I have actually done it. So with call options, that is the right but not the obligation to buy 100 shares per contract in a certain time frame at a certain price. So for example, if you buy a call contract on Apple with a 6-month expiration, and let's say it's trading at $150 right now, but if you think that the stock is going to hit maybe $200 in 6 months from now, you'll be able to buy the shares of Apple for $150, but they're actually worth $200. So you're technically up $50 per share. But remember, when you buy one contract, it's times 100 shares. So you're actually up $5,000 because 100 times 50 is 5,000. Now with put options, let's do the reverse. Let's say it's $150 right now, and in 6 months from now, it's $100 a share. You're able to sell your shares for $150, even though they're only worth $100. So a lot of people like to buy put options if they think the stock market's gonna go down. It's kind of like insurance on their portfolio. So now that we have that stuff out of the way, we are going to dive into the wheel strategy, and it's going to show you how I make hundreds of thousands of dollars every year. So here's what we got. So the first part in the wheel strategy is to sell a put option. So remember, in order for any trade to go through, there's a buyer and a seller. So instead of buying the put, we are going to sell the put. So the first part in the wheel strategy is you have to sell a put option. So when you sell the put option, let's just say that the current price of Apple is $100 a share right now, okay? Maybe you sell the $90 put contract. So if you sell the $90 put, you are required to buy those shares for $90 a share anytime between now and expiration date. So if Apple stock goes up, stays flat, or stays above $90 a share, you just get that premium that they paid you and nothing happens. That's just selling put options straight up. In the scenario that Apple falls below $90 a share, so let's say that Apple falls to $85 a share, you are required to buy Apple stock for $90 a share, even though it's only worth $85 a share. So technically on paper, you're down $5 a share. So now the big question is, what do I do with these shares? So in order to do the wheel strategy, you will then turn around and sell covered calls on those shares. So what does it mean when you sell a covered call? So if the current price is 85, but you bought them for 90, you would turn around and say, I'm going to sell one contract, which is 100 shares, because we're assuming that you were forced to buy 100 shares on the put. So then now we're going to try to sell those 100 shares back. So this would be covered because you own the shares. So if you turn around and you sell covered calls, you will collect premiums. Maybe we do 1 week covered calls for a $90 strike price. Let's just say in a 1 week time frame, since you're probably going to be on margin while you're sitting on these shares that you were forced to buy because of the put contract, maybe you're accruing $200 a week in margin interest. It depends on your broker, but we'll just overshoot this by a long shot. So let's say $200 a week is what you accrue in margin interest. If we could sell these covered calls and make $500 a week, you're making $300 profit after you pay for your margin interest. So this is one of the main main reasons why, number one, you have to do the wheel strategy on a stock that you are okay to hold for the long haul. For example, what if you do it on a company that's trash where you sell a $100 put and then it falls to $50 a share and then a company goes bankrupt? You're stuck with those shares and you're probably going to lose a lot of money on that. But if you do it on something like an ETF like Triple Q or like Apple stock or Microsoft, something that is established, eventually the longer that you hold those shares for, the more that they're going to trend back to what you were forced to buy them for. So if you bought them for 90 bucks a share, but they were only worth 85 bucks a share, and then maybe they dip to $80 a share and then they trend back up, during that whole trend up period to what you were forced to buy them for, you turn around and you sell covered calls on that, you make the weekly cash flow on those shares, and the cash flow will be more than what you're paying in margin interest. And then eventually when they get to the price that you bought them for, you just sell them, and then you just rinse and repeat this process over and over and over again. Now, I need to say this one more time, only do this on something that you are okay to hold for the long haul. Do not do this on penny stocks or trash companies. Do this on things that are established and they're good for the long haul. So now we're going to dive into my portfolio, and I'm going to show you a couple of the trades that I actually have open right now. So as you guys know from my other videos, I am bullish on the Russell 2000 in the short run. I think that if Trump gets elected, that's going to be good for deregulation and mergers and acquisitions for these small cap companies, which is good to make them more money, and they merge and they become stronger companies if three go into one. Also, interest rates are probably going to go down in the future, which is also good for small cap companies. So over here, I bought 15 contracts, 220 strike price on IWM that expires 6/20/2025, and then I also sold some puts on IWM. So those I'm up $7,000 on and 250 bucks on. These trades are pretty fresh. I'm gonna let these fizzle out for at least a couple more months, and then going into the bulk of my put contracts that I sell, I have all these open on Triple Q right here. So 10, 10, 10, 10, 10, 10, 10, and the strike price ranges from like 350 to 400 bucks. And then I also made a trade on Tesla before it just made this huge pump about a month ago, and I sold 170 puts with an expiration date of 6/20/2025. Those ones I'm up $15,000 on. So one of the main things that you guys need to understand is just because you have the buying power or the ability to make trades, we don't just trade to trade. We trade for things that we have high conviction in. Now I understand that the wheel strategy, the whole point is to sell the put, get assigned to shares, and then sell the covered calls and rinse and repeat. But I like selling just puts straight up a little bit better, and then I use the wheel strategy as an option. If the trade goes down and I'm forced to buy the shares, I'll just turn around and sell the covered calls. So my goal is to never get assigned the shares, but if I do get assigned the shares, I will do the wheel strategy. So this is my portfolio and my rate of return for 2023. So by me doing this strategy, the stock market did roughly 20-25% last year, okay? My return last year was 75%, okay? 75%. This is actual profit. This does not factor in me sending money to Charles Schwab and then, oh, that makes your return go up because the portfolio grew by that much. No, this is legit profit that I made on my money, 75% ROI, okay? Now imagine if I just compound at a rate of 50% for the next 5 years. I mean, my portfolio is gonna be like $5 million from 700K right now. So the main idea behind selling put options and doing the wheel strategy is I get credited a premium to my account right away. So when I sell the put and I make $10,000, that goes to the cash balance on my account immediately. I turn around, I take that $10,000 and I go buy more shares of things that I like, such as Triple Q and VOO. So as the stock price either goes up, stays flat, or doesn't go below my strike price, that contract is going to decay. So the quick thing about decay is, let's just do it as an example. If you live in Florida and you buy hurricane insurance, okay? If you want to go to State Farm and say, I want to buy hurricane insurance, but I only want to buy it for 1 week. They're like, okay, it's going to cost you 50 bucks. But if you want to buy a 1-year insurance policy in Florida, instead of it being cheap, it might be like $5,000 because there's more time for something to happen. So if there's more time for something to happen, the contract is usually going to be a little bit more expensive. So assume that the share price of Triple Q does nothing, okay? Maybe I get $10,000 in premium for that contract. Over time, that contract is going to go down in value because there's less time left in the contract. There's less time for something bad to happen. So that means the contract is just worth less money. So as the contract decays, I'm making profit because remember, I sold this contract. So my goal is to sell a contract that is worthless. So if this contract I sold it for 10,000 bucks, maybe 2 months into it, if I sell it for like a 6-month duration, it might be worth $6,000, assuming that the share price did nothing. And it's only worth $6,000 just because there's less time left in the contract. So I essentially just made $4,000 for doing nothing. Now also keep in mind, historically speaking, if there's 250 trading days in 1 year, okay, how many days do you guys think on average for the triple Q is green versus red? I'll answer it for you. Roughly 65% of the time, the triple Q is green, okay? So if the triple Q is usually green, why don't you want to be on that side of the trade? Why do you want to be on the side of the trade that is only the 35%? That's like going to a roulette table and betting on red, but there's only 35% of the thing is red, and there's 65% that is black, but the payout is still the same. So I feel like the factor of the decay, the fact that the companies in the triple Q are going to be better, bigger, stronger a year from now, most likely, and the fact that I get that decay, selling puts is a huge asset to your tool bag to be able to make your portfolio get returns of 75% last year like I did for mine. And then if you happen to have to do the wheel, if you get assigned the shares, you could just sell the covered calls to get rid of the shares. So this is my strategy. If you guys made it this far in the video, please like and subscribe, and I'll see you guys later.